This conference will now be recorded.
Okay, we will get started since it's 9 o'clock. Thank you so much for joining us this morning. Today, I'm going to talk about the true cost of tapping into your 401k account before retirement. And for those of you who don't know me, my name is Jenna Witherbee, and I'm one of the advisors on the team at 401k Plan Professionals. We focus 100% of our time on corporate retirement plans, servicing both the plan sponsors who offer the plans as well as the employees who participate in them. So today's webinar is a part of our quarterly webinar series. Each quarter we will spend about 10 to 15 minutes talking about a variety of different topics. And in addition to presenting it live, we will also send out the link to the recording afterwards, and we will post it on our website, www.401kplanprofessionals.com, and we will post it on our YouTube channel as well. So you can subscribe to our YouTube channel. You can just search us at 401k Plan Professionals. So taking money out of your 401k in retirement is one thing, but today we will be discussing the three main types of early 401k distributions, which are loans, hardship withdrawals, and then withdrawals upon termination from your employer, so leaving your company that you're working at. And what I'm going to be talking about today is just more general information. Every plan is different as far as the specific rules, and so you always need to just check and make sure that you're following your specific plan document provisions. Not all 401k plans allow for loans, so this provision is plan specific, but what a 401k loan allows a participant to do is to borrow from their 401k account and then pay themselves back, typically by way of a payroll deduction, and you're paying yourself back principal plus interest. There's restrictions on what amount you can borrow, and then plan sponsors could even place more restrictions on the types of money that you can actually borrow from and the reasons that you can borrow for. Ultimately, if a participant takes out a loan, they receive the check, they receive the money from the provider, and then they begin making loan payments to themselves, principal plus interest, with after-tax dollars. Some costs associated with taking out a 401k loan could include the loan fees themselves. Typically, there's a loan initiation fee and then an annual kind of administrative fee. Potential lost earnings. So because you're taking the money out of the account, that money is no longer invested. So you have to think about potentially lost earnings from not being invested during that time frame. Double taxation potentially of the money. And not a lot of people think about this part, but if you take out pre-tax money by way of a loan, the loan payments are made with after-tax dollars, and then down the road in retirement, you have to pay income taxes on that money again. So if you're borrowing pre-tax dollars, that money is essentially taxed twice. Another cost consideration would be if you left your employer and you have an outstanding loan, what happens? Well, you can either pay it off in full, or if you don't, you default and you get a 1099-R, and you have to include that money as regular income subject to taxes and potential penalty tax. So a lot of different things to consider. Loan cost calculators are available for free all over the internet, and a lot of providers have them as well, kind of integrated into the participant websites. So it's nice because you can illustrate how much a loan would potentially cost you, not just the dollars you're receiving, but kind of the hidden costs, so to speak, based on the assumptions you put into this tool. So this here is just an example, but I put in a loan amount of $5,000, assuming a 4% interest rate paid on it, paid over 5 years. And then my current federal income tax rate is 25%. I have a medium probability that I would leave my employer within that 5 years. And my loan fees were $300, and my expected rate of return on the money in my 401k is about 8%. So all of that being said, the total potential cost with taking that $5,000 loan are actually about $3,000 from the lost potential investment earnings, the loan fees themselves, and then default risk. So basically the risk that I would leave my employer and default on that loan. So this is a really impactful way to see the cost, and take it with a grain of salt. Obviously, you're putting in assumptions there, but it's a nice tool to have. Another type of early distribution is a hardship withdrawal. And just like loans, hardships are not required to be a plan provision, but many plans do allow for hardship withdrawals. Unlike a loan, which would be repaid back into your account, a hardship withdrawal is a distribution for yourself, your spouse, or a dependent for what the IRS deems as an immediate or heavy financial need. And there are 6 hardship reasons that the IRS determines: medical expenses, funeral expenses, higher education expenses, purchase of a primary residence, preventing eviction or foreclosure on your primary residence, or home repair due to a catastrophic event. You do have to provide documentation for the amount that you're requesting to withdraw. So you can't just come up with an arbitrary amount. You have to show bills. You have to show a purchase agreement if it's for a home, things like that. So hardship withdrawals, like I said, they are not repaid back to yourself. They cannot be repaid. So this is more of a early distribution. It's treated as a taxable event, and it's reported on a 1099-R form that someone would receive after taking a hardship withdrawal. The amount distributed must be included as your regular income for that year. Therefore, taxes come into play, federal taxes, potentially state income taxes. And then if you're under age 59 and a half, there's a 10% penalty tax for early withdrawal. In most cases as well, if somebody takes a hardship withdrawal, they're suspended from contributing to the 401k for 6 months. Therefore, there's costs there with not being able to save. And if your employer offers a match, you are missing out on that match for 6 months as well. Employers are not required to offer this provision, like I mentioned. So it's always a good idea, just check with your plan administrator, find out what provisions are allowed, and always think carefully before requesting a hardship withdrawal. There's many costs there that you need to consider. Here's just an example. Let's say I needed to take out a $10,000 hardship withdrawal I wanted to use it to purchase my primary residence. And let's say I'm in the 25% federal income tax bracket. So right off the bat, I can assume 25% gone for federal taxes, and then I'm under age 59 and a half, so there goes 10% for my early withdrawal penalty. So my $10,000 really becomes $6,500, plus if I wanted to add in the consideration if I had state income taxes withheld as well. Plus, I wouldn't be able to contribute to the 401k for 6 months, and I'd miss out on 6 months worth of an employer match. The last early withdrawal we'll talk about today is simply a withdrawal upon termination of employment. So if you change jobs, typically you have several different choices. You can leave the money where it's at in the current 401k account as long as you have a balance over $5,000. You can leave it there as long as you want to. You can roll the money into an individual retirement account or a different retirement plan. Lastly, you could cash it out, and that's what I'm going to talk about today, is cashing out your 401k or a part of your 401k upon leaving your employer. So withdrawal cost considerations here, if you're under age 59 and a half, would be regular income tax withholding, 10% penalty tax for early withdrawal, and then the potential lost earnings. You have to start all over saving if you cash out your 401k account. If you're over age 59 and a half and you cash out some or all of your 401k upon leaving your job, you would have to consider the income tax withholding and potential lost earnings. So you get away from that 10% penalty tax, but there's still costs to consider there. Just like with the loan cost calculators, there are many early withdrawal cost calculators online that are free. Here is one showing an example of a $5,000 early withdrawal by someone who is under age 59 and a half. Let's say they just changed jobs. According to their tax bracket and other assumptions that were put into the tool, the $5,000 withdrawal actually becomes more like $3,250. Additionally, something to think about is if I would have left that $5,000 in the 401k, or let's say rolled it to an IRA, invested it there, by the time I reach retirement, which I told the tool was 20 years away, this money could have grown to potentially over $19,000. So I like this because it not only gives you the short-term cost implications, but also it's thinking about the long-term, right? So key takeaways here, with loans, hardship withdrawals, withdrawals upon termination, always check your specific plan rules. I'm just generally speaking, every plan is a little bit different as far as their rules and restrictions. And so always make sure that you're checking your specific plan. Consider all these true costs. I think sometimes in the heat of the moment, these costs are not considered. And so we just want to kind of get the education out there, get the word out there, kind of lay it all out so people can really be sure that they're making the right decision. And certainly reach out to our team if you have any questions, want us to kind of walk through your options or go through specific examples with you. So thank you so much for joining today. Again, if you have any questions, don't hesitate to reach out. Our next quarterly webinar will be the first week in November, so we hope to see you then. Have a great day. Bye-bye.